right, which we use rights law to do, is really important. I think AI will really help us with that. This is painstaking work. And then we'll see how that leverages us. I would not discount human ingenuity, especially our research teams. Moving up a wall of worry, which is a very healthy bull market. And what do you know? It is broadening out, which is very exciting. And we're really happy that blockchain technology is a part of this movement, this broadening out in the traditional financial world, getting exposure to this new asset class. Really important.
Hey guys, welcome to Everyday Finance. Cathie Wood confirmed her remarkable prediction of a price of $1.5 million for Bitcoin. And she linked her expectations to the growing significance of stablecoins in the process of pushing adoption. Hello. She is optimistic about the long future. The short-term outlook appears to be uncertain. Bitcoin saw its most significant monthly decline as price fell below $113,000. Traders are keeping a close eye on the periodic ghost month, which has a history of bringing about significant price drops. In previous cycles, there were declines of approximately 40% in 2017 and 23% in 2021. The daily chart has just displayed a bearish engulfing pattern for the first time since July. Now, the bulls need to defend a critical line that is located around $116,000 to $117,000.
After 0809, we were watching trends in the financial markets. And I remember at one of our brainstorms at my last firm, one of the trends we were observing was mutual funds losing share to ETFs. And I wanted to know what an ETF was, because they were only used in the passive world, not in the active management world. And we're active investors. We trade every day. Whereas passive rebalances maybe once a quarter or twice a year. And when I learned what it was, I said, well, why can't we put an active fund inside an ETF wrapper? And I volunteered to do that at my last company because they got exemptive relief to do just that. And I realized two things. One, this was going to be disruptive to the mutual fund world because the fees in the ETF world are much lower when you count all of them up. There are a lot of hidden fees in mutual funds, whereas ETFs are just much more transparent in every which way. So I think the reason ETFs took off and the reason we have done very well is we were responding to the market's demand for transparency. They needed to be on the journey with the manager because they had lost a lot of trust in the financial markets in 0809. And we understood that. And we also wanted to do something that other asset managers weren't doing. Many were becoming much more benchmark sensitive. If they weren't going passive, they were going benchmark sensitive, which means they all started looking alike. You look at all the large cap growth managers, no matter who they are, they're probably going to have a lot of the Mag 6 right at the top. We do not. We're a diversified exposure to disruptive innovation. But so what we wanted to do was say, we're not doing that. We're trying to give you exposure to the way the world is going to work. And, some of these very successful companies, they helped build the world as we know it. If there's all this disruptive innovation taking place, technologically enabled, some of them are going to be disrupted. Some will be able to adapt, but we will go to the pure play disruptors for our largest positions. And so that's how we've blazed a trail. It was not a popular strategy. I would say for about 3 years, 21, 22, 23, and part of 24, because the market was, it was a bull market, but it was concentrating towards just a few stocks, especially the Mag 6. And we were characterizing that as, yeah, you might call it a bull market, but it's not a healthy bull market. A healthy bull market broadens out and benefits many other companies. That's what's happening this year. So your original question is, why did we decide to do it this way? Demand for transparency. We wanted to bring our clients along with us for the journey. We had no idea during 2020 how that would blow up, because everyone was at home and they didn't have much to do other than maybe shop online and invest online, right? And here we were giving research away, we were posting our trades, and there were YouTube videos about our trades, about why we were trading stocks. We had no idea about these videos all around the world, especially in Asia. So we grew a global brand because we were willing to do something that helped people. And I think our openness, especially during COVID, I remember in March and early April of 20, we developed a point of view. And as I just described, my background is economics, and I feel it's really important to have a point of view. It may not always be right, but you have to have a point of view and be open-minded. So during COVID, I was just doing, I was doing economic models in my mind and on paper saying, wait a minute, massive monetary stimulus, massive fiscal stimulus, everyone's at home, their savings rate is exploding. I think the saving rate got up to 27%. Now it's around 4 or 5%. And I said, it seems like this is a recipe for a boom and supply chain problems, because we have this virus going. And that's exactly what happened. And it caused a lot of problems, a lot of volatility, a lot of consternation. The Fed taking rates up the way it did really, really was very difficult for any companies with this innovation mindset, particularly if it didn't involve the Mag 6. It's not like the Mag 6 aren't going to participate. They're just not pure plays anymore.
Demand signs imply that dip buyers are turning their attention to the market despite the rising pressure. The demand in the United States is robust, as evidenced by the Coinbase Premium Index reaching monthly highs. Meanwhile, in Korea, the kimchi premium has turned positive once more, indicating that local retail is enthusiastic about the product. The trend is strengthened by stablecoin flows. After the decline, more than $3.8 billion worth of USDC moved on to exchanges, which is an indication that traders are getting ready to accumulate this cryptocurrency. If the past is any indication, Bitcoin may still be able to test the $118,000 zone before putting on a significant rebound.
I'll answer that question in a couple of ways. I think the low-hanging fruit for AI is in the passive / benchmark sensitive place. And that's where many investors moved as the Mag 6 seemed to be the only thing working, right? And so I would be more concerned about benchmark sensitive strategy or quant strategies. Quants using factor analysis, slicing and dicing. It's interesting and I don't know how quant oriented your user base is, but when quants look at our strategy, they're unable to define in terms of the various factors factors they have used as categories. So growth, quality, which typically means lots of cash and cash flow, volatility, profitability, different factors. When they get to our strategy, there's a huge percentage in what's called residual. We can't explain this. That the reason they can't is because the future's not going to look like the past. And we're invested in the future. And so quant is all about the past. So that's a good thing. So I think quant-based strategies will be overtaken by AI. They'll be completely commoditized. They're heading that way anyway. Our strategy demands original research, and we give our research away, We can feed it to OpenAI, Grok, the large language models, and there's a certain pattern recognition they will be able to discern. But that will help us and take us to the next level. We won't have to spend as much time on that anymore. And I'll just give you the centerpiece of that is Wright's law. So Wright's law is a relative of Moore's law. You've heard of Moore's law in the semiconductor space. So twice the power at the same cost every 18 months to 2 years. Moore's law is a function of time. Wright's law is a function of units, the number of units produced. The more the units are produced, the more costs fall. And so getting that cost decline right, which we use Wright's law to do, is really important. I think AI will really help us with that. This is painstaking work. And then we'll see how that leverages us. I would not discount human ingenuity, especially our research teams. Oh, I would say good job in terms of being open-minded and not panicking. I did go through and just enjoy the process, really. So definitely if you do get to college without an idea of where in the world you're going, then that's the time to sample as much as you can, anything that interests you. Because, I have found, with people who have joined our firm, with my own life, if you lean into what you love learning and, want to be a part of that ecosystem, your life is going to be very enjoyable. I'm not going to say it's stress-free, but on balance, I still love what I do. I love it. I love it so much. And, all the seeds for what is happening in innovation now, all of those seeds were planted in the first 20 years of my career. And so I've had the privilege, luxury, honor of watching them germinate and now seeing them flourish. And I'll just end on this, just to give you a sense of investor psychology. In the late 90s, a lot of these seeds were planted. Capital was just flowing, money was being thrown at anything .com, internet, biotech, anything like that. And, we knew it was too early. IPOs were coming out, the price would quadruple on day one. We said, that's crazy. That's crazy. These technologies aren't ready yet to scale, and they're way too expensive, which is one of the reasons. DNA sequencing, first human genome, it cost $2.7 billion to sequence one person's genome. That was in 2003. It finally was done. Today it's $200. It's ready to scale. And so what's the worst performing sector of all in the innovation space? That sector. And it just gives you a sense of crowd behavior. When you see, the money is just so easy to make, you could throw darts and become very wealthy. That's usually a bubble, or it's heading for a big correction. When you see a time like you see now, where there's a wall of worry, people are worried about everything, and they are not throwing their money at one of the most important areas in AI, healthcare. It's the most profound application of healthcare. When they're not throwing their money, then we're moving up a wall of worry, which is a very healthy bull market. And what do you know? It is broadening out, which is very exciting. And we're really happy that blockchain technology is a part of this movement, this broadening out in the traditional financial world, getting exposure to this new asset class. Really important.
The unstaking queue for Ether has reached a record high of $3.88 billion, with more than 877,000 ETH waiting to be withdrawn. A significant portion of this ETH is concentrated in Lido, Coinbase, and other platforms. Ether is experiencing its own unique pressure. The wait period has increased to 15 days, which indicates that there has been a significant repositioning of liquidity. The demand from institutions is rapidly increasing, despite the fact that some of this indicates profit-taking. As a result of short-term selling, Treasury and ETF reserves have increased by 140% since May, reaching a level that is now greater than 10 million ETH. Some investors may be releasing capital in order to invest in upcoming exchange-traded funds, ETFs that participate in staking. Despite this, there are still risks. A decline below $4,200 might result in liquidations totaling more than $1.2 billion, which would open the door to a decline toward $3,900.